many bulls out there make so little money? And welcome to the 13 Market Moves Weekend Edition, where we help dedicated traders to go to the next level. In this video, we're gonna talk about the myth that traders make money in the bull market by being bullish. What the hell did I just say? Oh, damn, Leonardo, you just said that? Damn right I said that, because that's exactly what I meant, y'all. Guys, this is going to be an incredibly important video if you are trying to take your trading game to the next level. We had a phenomenal week here at 13 Market Moves. If you haven't doubled or tripled your account this week, guys, this video is definitely for you if you are trying to improve as a day trader or a swing trader. So with that said, if you look at the markets simply from the perspective of being bullish or bearish without really getting an in-depth understanding on how to actually put individual trades on individual stocks together, specifically intraday, knowing your exits, knowing your entries, you're missing on some incredible gains. And guys, you know, my mission is not for this channel to get 1 million subscribers. I don't care about that. What I do care is about helping a handful of guys achieve some phenomenal results. So by the end of this video, you will have a clear understanding. Just because somebody says and maintains a bullish perspective of the market, it does not actually mean that they are making money by being bullish. I know it sounds shocking, but I'm going to show you the details that will reveal to you the absolute truth about day trading this market. Now, you will make the most use out of this video, guys, if you're an active trader. So if you're a long-term investor, it's highly desirable you finish watching this video till the end to understand some specifics and details that can also help you out. But you will make the most benefit out of this video if you are an active trader, specifically if you're trading weekly options. We're going to give you some specific recommendations of what you can do starting today, tomorrow, when the market's open, Monday, Tuesday, that could help you take your trading game to the next level. So to extract the most value out of this video, I hope that you're not brand new. They have some basic understanding of how to make money when stocks drop, how to buy put options and things like that. And hopefully you've had a chance to get acquainted with the terminology used within our channel, specifically pertaining to 13 market moves, charts divergences, pattern recognition, and so on. Now, if you are brand new, it's fine. I would just highly recommend that you go and watch the last 500 videos that we've posted on this channel on this subject. So the purpose of this video, guys, is to help you understand your entries better and how to adjust your strikes as you're trading intraday, specifically going into Thursday and Friday. So if you really want to learn, guys, finish watching this video till the very end and do take notes. Like, I'm shocked how many guys actually get on the phone with me like, Leonardo, I want to trade like you, man. I want to do these trades 4K to 60K. And then I find out, like, most of these guys, they don't even finish the video. They only watch it to like minute 3 or 4. Okay? So guys, like, there's no shortcuts. If you want to do this right, you got to use every moment, every opportunity to get better. Just like pretty much with everything else in life. You want to get really good at something, you got to go the extra mile. Okay, you got to put in the hours, you got to put in the work. This video is designed for those of you that instead of doing a bunch of stuff out there this weekend, you're actually trying to understand, learn the markets so you can take your trading game to the next level. Now, just a quick disclosure. We had a bunch of goofy guys complaining. If you don't like hot girls, big boobs, and bubble booties, and if you don't have any sense of humor, or if you think that proper spelling is required to be an awesome trader, okay, unsubscribe now. If you like to whine, bitch, gossip, complain, if that's the only reason you're here, guys, fuck it, unsubscribe. Again, I'm not trying to save the universe here. I'm not trying to be in a competition for the most subscribers on the trading channel. I don't care about that. The only thing I do care is a couple of 100 guys that are going to use this information to pay cash for their house this year. A couple of 100 guys that are going to make $200,000, $300,000, $400,000. And about 10, 20 guys that are going to make $1 million with me this year. That's all. I understand I can't help the 12,000 subscribers we got here right now, but I do want to help just a handful of guys that are committed and they're really trying to make something out of themselves as a trader, are really trying to pursue their dreams in life. And I wanted to do this now, not in the next 30 years, not in the next 40 years, that would like to learn something they can do today in order to make their dreams a reality tomorrow. The one question you should be asking yourself when you wake up in the morning, now that is if you're trying to perform as a high performance trader. If you're just trying to perform as everybody else, who gives a shit? Okay, but if you're trying to perform at the highest level, look at yourself in the mirror when you wake up tomorrow and ask yourself this question. Do you believe that you will be an awesome trader tomorrow? Do you believe that you will be an awesome trader this year in 2020? And if your answer is yes, then you should understand this. If you have hope in the future, there is power in the present. In other words, what you do today matters. What you learn today out of this video matters. And that's why I want you to get off your ass, grab the pen and paper, and watch this video with the highest level of intensity than you have ever watched any other trading video ever before. Now, to make the most of this video, guys, I highly recommend that you review these two videos. Yes, the one video that was posted last Sunday, February the 9th, one chart pattern you must know for day trading earnings this week. So, very important. The one chart pattern that was explained there produced returns of over 2,000% this week. I want you to understand. I want you to go to the root of what was explained in that video so you can get better. And the second video, the one that was just placed yesterday. It was posted yesterday on this channel, guys, on February 14th. Breaking down how to trade the XPE, BKNG, Roku, and NVIDIA earnings. Giving you all the details on that. So review those two. Or if you have watched them, let's roll. Let's move forward from here. Real quick, not to make fun of anybody, but to illustrate the subject so you can remember this better, I will first walk you through what a typical trader would do, and later I will contrast this with how we do things here utilizing the 13 markets move formula. Any so-called bulls that claim they made money buying calls Friday are simply lying. Here's why. Now, most of the typical traders, okay, they condition that the best time to trade is to trade the open, 9:30 to 10 o'clock. Now, pretty much unanimously, 99% of the traders, okay, they have this bullish bias right now. Okay, they're bulls, no matter what. They're bulls. Oh, the market can never drop. It's going to go to the moon forever. Okay, so most of the traders are so brainwashed right now that this is an infinite bull market that will never stop. They're conditioned to just go ahead and buy calls. And since majority of the traders, they're conditioned and brainwashed to believe that this time frame right here is the best time to jump into calls. Okay, this is what a typical trader would do. I'm going to walk you through it. So, considering the market was opening in the green Friday, February 14th, a typical trader would actually buy calls in the first 10 minutes of the trading session in the expectation of the markets going higher. So, and this made a lot of sense. I mean, if you are that type of trader. So, here's Amazon. Woo! Oh, that typical comment. Oh, Leonardo, everything is gapping up higher this morning. Okay, I know, which is not the ideal condition you want to have if you want to buy calls. You don't want to be buying calls when things are gapping up higher. Because when market gaps up higher, actually has a higher probability of a reversal. So this is where Amazon was trading, 2161, 2160. Now I'm going to scroll these down so you can see the time frame, right? So 907, 930, Amazon's trading about 2160. What else do we have here? BKNG, 930, 945, trades at 2024. Roku, 930 trades right here in the area of about 152, 153. Fast forward things a little bit. Here's the move to an Amazon. So, as a typical trader, you'll be like, hell yeah. Oh, Leonardo, god damn it. Ron, so wrong. I'm a bull and you're a bear, and I'm right and you're wrong, and I'm buying calls, and oh shit, he was right again. Why did I put those bad comments? Oh fuck, But no, I'm going to buy the dip. This is what they do at the Blue Point. They buy the dip. No, I've been posting those comments out there. Buy the dip. Everybody buy the dip. So they buy the dip right here. It bounces slightly, just a couple of bucks. And then we never hear from them again. I wonder why. Because it is a move to, okay, it's complete unwind. So the point here is this. It's very simple, guys. Just because somebody has a bullish outlook on the market, simply buying calls and maintaining that bullish view is not going to make you the money. So does it look like the guy that pulled the trigger right here on buying Amazon calls? Does it look like he made the money on Friday? Well, the answer is, it's not no. It's hell no. Second chart, BKNG. Does it look like calls made money? See, the idea is the most active trading point is the first half an hour. They were buying calls. They're so bullish. Come on, I can't wait for somebody to actually record how they were buying calls right here. Come on, bring it on. So move to BKNG. Now, interestingly, we're going to use this as a very detailed breakdown so I can actually help you guys improve. Because what was said in the video posted on Friday, we actually specifically said short BKNG at the open. At the open literally means right here. Okay, so if you pulled the trigger at the open, we initially suggested buying 1980 puts in BKNG. All right, so immediately after that, it reverses, hits the 1980. That would have produced 260. Now, that was actually lowest percentage gain in BKNG puts over the course of the entire Friday. So what you want to do is you hear often us talk about in the videos about shorting the bounces. So now it bounces. Now the only difference, these options now that you're buying here will coincide with a time frame about 12 o'clock, 11:12 right here. What you need to understand is these options right here, 1990 strike, they're sold for $1, actually 95 cents right here. And within 20 minutes, they're sold at 4.9. So that's a 500%er, guys. That's a 500% return within 30 minutes. Now, I'm going to share a very important step with you. I'm going to share a very important tip here in just a second for you to understand. But let me finish this chart. So bounce, you enter the puts again, and you make another 500%er. Now, notice this last final drop doesn't really come in until like the last 20 minutes of the trading session. In order for you to perform at this 260, 500, and 500%, it's very important to adjust your strike if you see that the stock is doing this. Okay, if you see the stock that typically reverses, and it could reverse by 40, 50 bucks, okay, it doesn't mean that you should be buying options that are $50, $40 out of the money. If you see the stock by midday, like 12, 1 o'clock, okay, if it's stalling out pretty much within the same levels where it was earlier in the day between 9:30 and 10:30, you should adjust your strike, okay? So we're talking about intraday trading. So shorting the open was profitable. That wasn't as profitable as shorting the intraday. Why? Again, we trade weekly options. We specifically deal with options that expire on Friday. Now, for those of you that might have taken this trade and you bought options that expire next week, there's no freaking way that you can get a 500% return. So understanding this is crucial. Now, also, those of you that bought next week expiration also invested a lot more money. So while we were investing couple $1,000 right here, by buying next week's options, you were investing 10, 20,000, and you're actually able to buy less options. Just because you're going longer on your expiration does not mean that the trade is less risk all of a sudden. See, most of the time, traders do that when they don't know exactly when the move is going to come in. So they often say like, hey, I'll just, I'll get me some extra time in the trade just in case. Well, when you're saying stuff like that to yourself, what you're really saying is you don't really know. And if you don't really know, you shouldn't be taking the trade in the first place. Does that make sense? So trading intraday, the initial message that was actually shown in the video was buying BKNG 1980 puts on bounce to 1990, 2000. Now understand, I record this video as pre-market. So naturally I wouldn't have the latest chart because I have to record them before the market opens. And so here's the deal. At the time I was recording the video, this was the chart right here. BKNG was at 1990. So if you're ever watching some of these 13 market moves daily analysis videos, what you want to do is understand that these charts are taken pre-market. Now the most important component of this chart was the fact that we described that BKNG stock was moving higher on very tiny volume, which was only about 300 shares. Now notice I'm suggesting shorting BKNG when it bounces to 1990. There was still in the cards that it could move higher, okay, let's say to 2000. And then we were suggesting to buy literally these puts that at this point would have been $10, $20 out of the money. And if you watch most of my live trading videos, guys, that's how I like to do it, okay? I don't want to go substantially out of the money unless certain conditions are met. So if you're really trying to learn how you could have done better on this trade, watch this. Okay, so tip number one is you want to adjust your strike if certain conditions are met. Condition A, if stock makes a sharp move higher at the open. So for example, in stocks that are highly priced, and there's not a ton of those stocks out there, but understand that if it's a $1,900 stock, $1,800 stock, and if it's an Amazon like a $2,000 stock, these stocks can move 20 bucks. I mean, it's not a big deal. It would be an equivalent of, a $20 stock moving, 10, 20 cents. So if you understand that, then you should position yourself properly. Now, you should have adjusted your strike slightly, okay? Noticing that, hold on, the same condition is met. It's not like all of a sudden BKNG is rocketing higher and stronger volume, but I understand that I don't necessarily now it's trading at the open, it was trading at 2024. So what you want to do is you want to adjust your strike. You want to go with 2000 strike, maybe 1995, 1990, okay? So, but you would have readjusted your strike price accordingly, okay? Even if you went with the initial strike price, right, you would have still made 260% gain right here on this drop within minutes, and then you would have been able to reposition yourself. But at this point, you understand, hold on, this drop stopped, the stock is bouncing, you could have adjusted for a better strike. So when you're trading intraday, guys, it's super important to understand, depending on how the market move is developing in the stock and in the market, it's important to acknowledge it and adjust the strike. Now, if trade moves sideways longer than typically expected on Fridays, what we mean by that is there's certain key stocks that would like to trade. And if there is a daily trading range of say $40, $50 in a stock, what you want to do is if all of a sudden the conditions are changing and all of a sudden typically the stock maybe would have moved $30 lower or higher within 3 or 4 hours that day, but all of a sudden the daily trading range is being diminished. Now all of a sudden the trading range is only 20 bucks, then you should adjust your strike price accordingly. In other words, if you maybe own the 1980 strike, but you see the stock keeps going sideways for a couple of hours and it has not done that in the last 5 Fridays, you understand, hold on, that's a bit of a shift in the environment here. I got to adjust my strike. So what you want to do is you want to sell the out of the money strike and you want to repurchase a higher strike. See, it doesn't mean that the trade is bad. It just sometimes you're going to have an awesome trade, but if you got the wrong strike, it could actually turn that trade into a loser. So, and for those of you that have been trading options actively, especially weekly options, that is oftentimes what it comes down to. It's about your entries, exits, and your strikes. So if you watch all of my live trade videos, guys, typically you don't see me going way out of the money on puts unless VIX is uptrending and numerically VIX is high, which is over 16. So in this condition, this Friday, we have VIX between 14, 14.5 level. So one of the conditions was not met, and VIX was going sideways to downtrending. So none of the conditions were actually met. So in this case, being $20 to $25 out of the money when you select your strike price is actually reasonable. Okay, so reasonable meaning you wouldn't want to be $20, $25 out of the money on a $100 stock. But considering this is a $1,924 stock, again, when you do the percentages and calculations, that'd be the same thing as buying, something 50 cents out of the money on like a $50 stock or something like that. Okay, so $20, $25 out of the money on a $1,924 stock actually makes sense. And so if I go back right here and show you one more time, okay, basically, watch the time frames. It's very important, guys. Write this down. Watch the time frame. So the stock pops on very low volume. The strike that was described in the video now should be adjusted because we're no longer opening at 1990 or 2000. Now we're opening $24 higher, which is fine. But you want to adjust your strike price. So the ideal strike price would have been like 2000, 1995, 1990. Okay, you would have made a huge gain. Actually, if you would select those prices, your gain would have been high. Then right here, same thing. See, we're going sideways for some time. So typically we'd get a bounce, maybe go sideways for 30, 40 minutes, an hour, and then would resume the drop. In this case, we stay sideways longer. Okay, and here's another red flag. As soon as we make this dip from 2009 all the way down to 1900, this is exactly the time interval where options go from like 90, 95 cents all the way to 4.9, creating that 500% return. Okay, then we bounce. Look at how quickly the bounce, and then instead of just sometimes you'll get quick bounces like this, and then the stock will immediately resume the drop. But in this case, we bounce rather quickly, and then we hold the sideways pattern. So that's not good. That tells you, hold on, something is just not right because it drops, bounces, sideways. Okay, now the strategy of shorting the bounce was insanely profitable. Okay, if you just got the right strike and if you capitalized on the drop trade intraday. Now notice how this strategy of shorting the bounce, the initial bounce at the open, the second bounce, and the third bounce, okay, create phenomenal opportunities intraday, but not the strategy of actually buying calls. Okay, if anybody bought calls right here, they lost their ass. If anybody bought calls right here, by the time the stock got to over here, they would have depreciated, they would have lost value, they would have decayed. At best, they might have locked in like, 50% return. Same thing here. Okay, so these bounces in relation to the drops, do you see how much smaller they are? So you get a drop from 2024 all the way to almost 1980. That's a $44 drop within like, 28 minutes. Then your bounce is much less than the drop, than the size of the drop, and then the magnitude of the drop. So now you're at this level right here. Okay, then notice the size of the drop, $20 drop in relation to the bounce. The bounce is only about 60% of the drop. Okay, and so if you understand this, you will tap into some unbelievable trades that other people are just simply blind. They don't see them. But this is how you're going to make a bunch of money. Okay, so enough time spent at BKNG. I hope this makes sense. So again, to review this, adjust the strike as the day continues on. Adjust the strike if you see the stock keeps hitting a certain level and hesitates to move lower. Adjust your strike higher. That is, of course, the case when you're trading put options. Okay, Roku. 150 puts at the open. Look, the stock was moving higher on the great earnings report. Okay, that is what we said in the video. This is what happens next. Does it look like calls made money? So all these guys are saying, hey, man, Leonardo, the market closed positive, man. There's no way you're making money on puts. Screw them. They don't know what the fuck they're talking about. Okay? So does it look like they made money? So let's say they were bullish and they decided to go ahead and buy calls. That's why they're not leaving comments today. Because these guys, they're destroyed. Okay? So buying calls when the first 10 minutes, 30 minutes of the trading session here was a disaster. And guess what? The same guy is like, no, I know I'm right, man. Let me buy the dip. I'm going to buy the dip, man. Okay, where is he at now? Now, the worst thing is being bullish actually conditions you to buy the dips. And so when you're buying the dip here, temporary, you get a smile thinking that you're right, but then like damn it, you just get completely wiped out. Okay, so basically, guys, what it boils down to is having this crazy bullish outlook, okay, prevents you from taking some insane trades. Guys, this was like an insane trade, 800 to 2,800% in less than 5 hours. From here to here, baby. And guess what? If you would have used the strategy of shorting the bounce, okay, then if you missed this initial drop, you could have gotten on the bounce right here, and you would have still made 500 to 1,000%, guys. All right. There's some other trades that we talked about. ANAT, EXPE. Now, those of you might not have watched that video. It was another video talking about Amazon and Shopify the day before, so that's why we're showing these as examples right here as well. We noticed this reversal pattern in both charts in Amazon and Shopify, and that's why we switched from being bullish to being bearish on these two stocks. Okay, so ANAT, boom, where's it trade at the market open? 227. Said short it on the bounce, short it at the open. EXP, shorted on a bounce. We said when the market opens at about 225, 226. Shopify, short the bounce. Okay, so ANAT, 225, 220 puts at the open, guys. Next trade described in the Friday video. ANAT, 225, 220 puts at the open. Guys, you got to pay attention, right? I'm not saying ANAT 210 strike. I'm not saying ANAT 200 strike. I'm saying ANAT 225, 220 strike at the open. So where was the stock at the open? This is ANAT at the open at 227. How would you like to be a bull there? Okay, so while ANAT is dropping from 227 all the way to 217, okay, he's no longer a bull. He's officially a bear. Well, welcome to the club. Okay, so this move right here, guys, okay, all it takes, right, is about 33 minutes, okay, 200-300% gain. Weekly options. Guys, if you don't understand how the hell to do these 200-300%ers within 33 minutes, you got to click the link below this video and get more information. So you may be saying, "Oh yeah, but I bought the dip." Okay, and if you bought the dip, there's no way you would have made this type of returns because overall the stock stalls. It doesn't go higher, it doesn't drop anymore, and it is likely to continue lower next week. But guess what? You bought calls for next week, buying the dip, and guess what's going to happen by the end of the week if you keep holding them things? It's going to look like this, from 227 to 217, exactly the way you felt when this happened. This is exactly how you will feel next week because this stock is no good. It's got more room to the downside. Expedia. Notice, guys, notice specifics, the specifics. This video is about helping you watch the content on this channel so you can get better. Expedia, what strike? 125, 125. On what? On bounce to what? 125, 126. Okay, so there's two things that we can actually say about this trade and how you could have executed it. Number one, okay, you should have gotten the right strike. So 125. If you gotten the 125 strike, you would have made really quick return within the first 50 minutes of trading. about 200, 250%, no big deal. Okay, but if you got a strike that was like a 115 or 110, okay, those are not good strikes, guys. Okay, we're not trading BKNG, right? Where, you know, it could drop 20 bucks in 20 minutes. This is a $100 stock. Okay, we shouldn't expect it to drop, you know, 25 bucks. But even if you bought 120, right, on that move right here, this was a 300%er in the 120 strike. Not bad, right? But the idea is this: your strikes do matter. Your entries do matter. And there's no way, if you're a bull, that you would be using this. Okay? Now, you may be saying, oh, Leonardo, come on, man. I don't trade the open, man. I'm better than that. I'm better than you. I'm better than that. And I am a bull. And I bought the dip. Well, the question is, if you bought the dip, okay, let's say you nailed the damn dip and you bought it perfectly. Still, the stock ended up 122.5, 123. There's no freaking way, okay, you would have captured this much of a percentage return. Now, here's why. Now, this is overall a $5 move lower while you're capturing a $2 move. Okay, does that make sense? You know, I hope that makes fucking sense. All right, so tip number 2 basically is focus on strike prices. The only way you could have lost money on Expedia trade on Friday, guys, if you selected the wrong strike price and never adjusted it. So let's say initially you could have gone like 115. When the stock started bouncing out of the 120, you should have sold it. You should have readjusted your strike price into a better strike, and you would have done much better, okay? So your safest strike, guys, understand this, is the closest to the top of the bounce, okay, which basically allows you to buy the stock put at its peak price intraday, and you end up buying that put near the money, at the money, or slightly in the money. Those are the puts that will produce the greatest result. And in order to understand that, guys, you actually got to understand the stock divergences, the stock charts. We teach a lot of that stuff in our charts divergences course. So now here's the deal. Okay, in VDA, okay, catching a lot of bullshit out of this trade. And the question is why? Like, if you listen to the video tells you specifically what. On the other slides, we specifically said either short the bounce, or we said short the open, right at the open. On this one, we said what? We said wait till the stock bounces to 294. There was a reason why we said 294. 294, that's when we want to buy puts. You want to wait till the stock moves $6 higher and then short the hell out of it. Why? Because we shorted NVIDIA at 294 a year and a half ago. And we knew that once the stock was going to get to that level, it was going to hit a resistance. And that was the ideal level to come in and short the hell out of it. Okay? Guys, you got to know the charts. You got to know your levels. You could be saying, Leonardo, but I'm new. I didn't trade a year and a half ago. How the hell am I supposed to do that? How the hell am I supposed to know that? Guys, it's simple. You should make it a habit to go look at charts on different time frames in order to help yourself become a better trader. Okay, so you could argue, hey, we actually had a comment from the guy. Well, hey, I'm the man here. I bought calls and I sold the puts. Well, whoever that was that posted that comment, I dare that you would show us the trade. Okay, because right now you got to be very, very freaking nervous. Because I guarantee you, if you show us your execution, you were buying calls when the stock was here. Or you could say, oh no, I'm so good. I nailed it. I bought it at right here, 287, 288. Okay, fine. So what happened since then? So let's say you didn't jump at the highest level. Let's say you did buy it on the dip and then the stock bounced. Okay. All right, fine. So if you bought next week's options, okay, number one, if you bought this week's options, if you bought Friday expiration, the stock popped and it dropped, And if you stayed with this trade, okay, you would have not made money, because by the end of the day, whatever you were paying for the call option right here was actually less by the time the option got here, because you might have been paying a couple of dollars right here. By the time it actually finished the day, it was like $1. Okay, now understand this important factor right here, that the greatest trade of the day was actually pulling the trigger on the put side and shorting that 294. Okay, let me explain why, because if you understand this, like, this is very, very powerful. Okay, so when you're buying calls right here or right here, now the pre-existing condition, of course, okay, where is it? Maybe you can see it right here. Okay, so Nvidia on Friday, February 14th, was already up $19 when it opened. So it had a great report, great response, very positive reaction to the report, which is exactly what we discussed in the video. Now notice we didn't say, like everybody else said, oh, we're raising the price target on Nvidia. Oh, you need to go ahead and buy some calls. No, we said, hold on. Wait till it goes higher, $6, and then short the hell out of it. Okay? So understanding these key levels, understanding your entries, guys, is very, very powerful. So the point I'm trying to make is, when you're buying calls, when the stock is already $19 up for the day, okay, you're actually buying calls when the probability of the stock making another significant move higher, let's say it's already up $18, $19. What are you doing buying calls? Because you think it's going to go up another $18, $19? That shit ain't going to happen. But it's a lot easier at this point. Oh, you see, it's like, oh, it's in the green, 18, $90. Let me go ahead and buy calls. No. Like, I hope you didn't do that in Shopify 2 days ago, because if you did, you got killed. Okay, so the point here is this. This is the worst time to buy calls. If something opens up in the morning higher, this is the worst time to buy the damn calls. You don't want to do that. You definitely want to wait for a pullback if you're just completely insane, and you don't want to listen to anything that we teach in our channel. Like, if you want to just be a bull, that's fine. I mean, you're being a bull at the worst possible time to be a bull. The market is at freaking all-time highs, and it shows all kinds of signs of diversity, but go ahead. Just please record the damn trades and let us see them. All right, so here's the deal. This is the worst time to buy the calls. Absolutely worst time, because right now, when the stock is up $18, $19, the price, the highest, this is the highest fucking price you can pay for these damn calls. Okay? You may say, no, you're wrong, and it goes higher. Okay, well, please, don't fucking tell me you sold it here, because you didn't. Okay? Because at that point, you're like, yeah, I knew it, I'm right, hell yeah, there's no way. And then you're like, oh, well, it's making a little pullback. It's okay, I'm holding on, it's making another one. And right about here, like, fuck it, I can't take this shit no more, I'm out. Okay, so, sorry guys, I'm having too much fun here. Okay, so the point is, when you're buying these calls, you're paying the highest possible price. Now, when all the bulls are mesmerized by this magnificent $6 move higher that we knew was going to hit a wall when it was going to get there, based on our historic observations of the behavior in this particular stock, based on the numerous freaking hundreds of trades that we've taken on the Nvidia, we knew it was going to hit the damn wall right here. And the question was, this is the most important question if you're trying to understand how to day trade intraday on Fridays. Guess where the puts are priced right now? We said on Nvidia, buy 290. 290 strike put when the stock hits 294. So guess where these 290 puts were priced? 290 puts right here were priced when the stock was trading at 294. Guys, they were going for 45 cents a put. So basically, the 290 puts were worth the lowest possible amount you could have possibly freaking paid for them on Friday. And that's when you pull the trigger. So this drop right here from 294 to 288, okay, makes you a quick 400% gain, okay, like guys, within an hour. This is within an hour. Now this move did not produce a 400% gain. Why? It's because of what you're paying for these options. Again, the stock was already up $18, $19 higher. Everybody thought it was going to go higher. Okay, so nobody would sell you the damn options when the stock is $18, $19 higher. Well, everybody's raising the price target on the stock, and everybody looks like they're so optimistic about it. That's when you're going to pay the highest price. When you pay the highest, it's going to be very difficult for you to make these, 3, 4, 500%ers. It's going to be almost impossible. It's the cost of the options. It's not that you're wrong with your trade. Let's say you're really good and you actually understand the probability of the stock moving higher once it's already up $18, $19. Let's say you already understand all that and you're really good. That's awesome. But also understand that the second part of the equation is not whether you're right, whether something is going to move higher by another, let's say $4, $5, $10, but what do you make of it? In other words, how much are you paying? What is the cost of your option in relation to what you're going to be able to sell it for? So when you're looking at the same size move, right, from here, from 288 to 294 on the bull side, you're not making as much because your cost of these calls is substantially higher than the cost of my puts. On the same size move, I am making a ton more than what you're making on the same move on the call side. Now, I hope you understand this because this is key, okay? Understanding when you're actually getting a good price on the option and pulling the trigger at the right moment is the only way to make money with directional options. Because most of the people don't understand this. That's why you got so many bullshit gurus out there telling you that selling options is the best, most effective strategy ever. Because they don't know this. See, if they knew this, I'd be like, what the hell? I'm trying to invest $20,000 selling these options and I'm making 10%. Dude, I just shown you these move 400% mover within an hour. You're sitting selling your options waiting for a fucking month to collect 10%. Now tell me which strategy is better. Come on. Now on top of that, selling options don't work for selling options don't work for small accounts. So if you guys got a couple of grand in your account, good luck. Go sell some fucking options. That's not going to work. Okay? But here you can invest, let's say you're working with a small account. You can invest $300, turn it into $1,200. Within an hour, you're done. But guess what? You're going to say, yeah, but you can lose the money. Okay, fine. Yeah, you can lose $300. That's the worst case outcome. All right, but imagine you can actually get good with calculating these entries. Imagine you can actually get good with calculating this shit. So I'm hoping you're watching this video because that's what you're trying to do. Because that's why I'm trying to explain you this stuff. That takes me to the next most important point, guys. And that is, most of the people will tell you that trading weekly options is incredibly, insanely risky. That's a myth. Do you see how you can risk very little bit of money opposed to risking a lot of money? See, the guy that sells options, even though he's not going to admit that, he's risking $20,000. Why? Because he's got $20,000 tied up into the trade in order to make 10%. So he's risking 20 to make 2 grand. We're risking 300 to make 1,200. Tell me which trade is better. From the risk reward perspective, our trade is 100 times better. And it works for any size account. All right, moving on. All right, this is actually, so I don't have to record a separate video. This is a quick review of the BABA trade, guys. A quick review of the BABA trade. So on Thursday, we posted the video to our 13 Market Moves Daily Analysis members. Said, hey, short BABA at 223.40. Specific alert was sent at 223.40. Now, BABA overall action was bullish, okay? But again, when the stock was moving higher, it didn't make sense to buy calls. What we want to do is we want to target the bounce. When put options become incredibly inexpensive, we want to pull the trigger here. Now, this trade right here, I mean, by no means, it was no prom queen. I mean, it was, a couple of 100%, or depending on what strike you were buying, you would have made 200-300%. But the idea is the same, right? So, again, if you've taken the BABA trade, but you didn't execute the entry correctly, okay, you would have not done as good. So buying, but also understand this. that buying, let's say, next week's calls right here, guys, when the stock was trading, let's say here at 219 on Thursday, buying next week's calls would have not made you any money. Shorting the bounce would have made you a good bit of money. The kind of money most of the traders don't freaking expect to make in a month. I mean, that's a couple of 100% right here. Okay, so understanding this, okay, when you buy next week or you buy next month, okay, you're committing a lot more capital to the trade. Okay, but this is what you're not getting, is that there is a risk at committing more money over a longer time frame, because what you can see is this, and basically sideways trend. So your sideways trend goes by, all of a sudden, hey, what happens? Your options decay. Your options lose value. So just buying extra time is not, it's just not the best strategy. So you're better off timing your entries. You're better off, doing a lot of studying on charts divergences, and really getting good at identifying this. When is that you want to short the bounce? At which point do you want to pull the trigger? At what price? At what strike, right? And specifically, if you go back and you analyze this BABA trade, we actually suggested 225, 220 strike. So when you're doing that, the stock actually drops 218. Okay, like you're making way more money than anybody would have bought calls, because anybody would have bought calls unless they sold them pretty much right away in the pop here. Okay, but again, if they bought next week's calls, there's no way they would have made the money that you made. Okay, so bottom line, just end of story, let's roll. Let's move on. I'm going to show you the most important thing right now, guys. This is how you could have made over 500 to 2,000% returns, meaning for every $1,000 you've invested, you could have made back 20K or at least 5K. And you would have been able to do that by watching our video posted last Sunday. Yes, another weekend extravaganza, 13 market moves. February 9th, this video, right? Again, one chart pattern. Guys, you gotta understand this chart pattern. Look, if I can drill into your head how important this damn chart pattern is, just understanding this one freaking chart pattern, okay? You're gonna be shocked the type of trades you're gonna be able to put together. While the bulls are being bullish, you're making 5x on being bearish. Damn it, Leonardo, show me this one chart pattern again. Let me take another consideration of this. So the chart pattern was showing you, guys, brief review, real quick. RCL, pay attention. I'm going to break it down one more time real quick. Watch this. What's this? That's called a gap down. What's this? That's called a bear reversal candle. What's this? That's called a black candle. What's this? Another black candle, another bear reversal candle. Basically, what you want to focus on anytime you have a gap down, on meaningful volume like here, look, we're not gapping down on, like this kind of volume. We're gapping down on some substantial volume. This is almost the highest volume on this fragment of the chart. The only candle that's high is this one. So when you have this condition, something gaps down, and it bounces, and it creates this type of candle. You want to acknowledge that, because the next move is lower. Now, it doesn't guarantee that there's not going to be further bounces, but further bounces are to be shorted. Okay, and they typically will result in a further drop. So understanding this, plus understanding some other things, guys, like there's a death hook going on, there's huge divergences right here when the stock failed to make that second attempt to break out higher. Look at where RSI was right here at 133. Look at where RSI is right now at 135. Substantial little. Guys, I don't have time to show you freaking everything in this video, otherwise it's going to be 5 hours long. But just focus on this. Gap down, bounce, short to bounce. Another drop, another bounce, short to bounce. I'm going to show you now a couple of instances of how you could have used this. Now, when you zoom in to actually pull the trigger, you see this candle around here? And you see this candle right here? Well, when you look at the 1 day, 1 minute chart, it's going to look like this. Okay, so this was a more detailed view that we've shown you last Sunday on February 9th, basically saying, hey, RCL, after the earnings, what does it do? It bounces. And we want to short this bounce because we already studied the chart and we know the levels once it's going to bounce to 122, 124. Guys, look, how the hell can we be so damn consistent at telling you exactly when is the right time to actually pull the trigger on these trades, guys? It's not a coincidence. It's the 13 markets move formula. It's the charge divergences. Okay, it's understanding how to look at things in a way that 99% of the traders don't have a clue how to look at. And you can actually learn how to do this, and you can get good at this stuff. That's the exciting part. So RCL 120 puts, we recommended shorting it on the bounce to 122, 124. The stock opens, goes to 123, and never goes higher, and then it reverses like a maniac. Okay, so this is how you could have actually used this chart pattern and used the details of shorting it on the bounce on a 1 day, 1 minute chart. Okay, multiple times this week. Guys, this is like, please freaking learn this shit. Here's exact breakdown of the first trade that was based on this pattern posted on February 11th. So this was the trade on Hasbro, explained in this video with a thumbnail that looks like this. Forgot what her name was. But anyway, Hasbro options today. Some other charts. At that point, we were bullish on Amazon. Amazon, since that, moved $50, $60 higher. Melee options, that thing had a reversal of like almost $100 since the entry to the upside. We've said buy calls on that. So all of these, guys, they were calls, and we had reasons to be buying calls on these things. Okay, so this one we did puts based off this one chart pattern. Damn it! What is it, Leonardo? Show me this shit one more time. One chart pattern shown on Sunday, February 9th, 20 video. So look at this. Do you see the details? Okay, just compare these details. What do you have? Earnings report, you have bounce on RCL. What do you have here? Hasbro. Have earnings report, you have a bounce. You say, Leonardo, what the hell? Hold on. This is a travel stock. This is Royal Caribbean Cruise Line. And this is a toy maker. How are you going to use the same chart pattern? Guys, it's because these chart patterns are so powerful that you can actually use them on any sector. Okay? That's the beauty. Now, let's review the pre-existing conditions. Let's look at the Hasbro chart. It may look at the first glance like it's quite a bit different because you got more of a prolonged sideways trend, but the idea is the same. I just want you to grab the concept, okay? So first, what do you have? You have a pre-existing condition of what? Huge gap down. Huge gap down on what? Have huge gap down on what? What do you mean what? Fucking higher volume, okay? Huge gap down on high volume. Stock drops, bounces. Now look what happens when it bounces. It drops, bounces, drops, bounces, drops, bounces, drops, bounces, drops, bounces, drops. And thank you, hallelujah, it bounces again. Yes. So here it is, as shown you in the prior picture right here, bounces after you guys just got a better view overall. That's why I recommend looking at multiple time frame charts. So now it's right here, 110, 109, 107. That is represented right here. 110, 107.5, right around here. So basically in that video on February 11th, we said, hey, you want to come in, buy these puts at the open, and then you want to target the level of 100 first, because that could be the first support area. You can take some profits there, and then watch the stock drop all the way potentially to 95. This could be a second area of exit. So here's the actual live trade execution, guys, showing you details of exact execution on this trade. And look, I'll say this. This by no means was perfect execution because I was a bit slow, like entering some stuff right at the open. So I didn't get the best feel, and I was a bit frustrated with that. But like, look, even with that, like for those of you that have taken the trade, got a better entry than me, guys, I know some of you down like 700-800% on this one. I didn't do quite as good, but I mean, here it is. Check it out. Boom, right here. Hey guys, what's going on in this video? We're going to show you how to turn $1,500 into $10K. We're going to buy some Hasbro puts. 100 level put. Currently the stock is trading at 107, so we want to buy actually about 30 of these puts at 30 at about no, we want 30 at 42. Let's see if we can get that filled by Okay, the order's sitting there, nothing is going on. All right, so that's why it dropped to 106. So we're gonna have to step up and pay more for these. So maybe 47. Nope, not getting a fill. All right, let's try to move that up to 50.
Order partially filled.
Okay, partially filled. Position 1. Damn it, we only got 1. Okay, that's not good. Now they're going for, what, 53. Look, we're just going to have to probably turn this order into a market order and just get as many as we can. Just buy them at market. Because I don't want to miss out on this entire trade. 25 at, I should have just entered this market order from the get-go.
Order partially filled. Order filled.
Damn it, I paid too much for them damn things. Average price 74 cents. That was horrible, horrible execution. Just horrible. Let's try to buy 3 more.
Order filled.
Alright, so we bought 2 more. Alright, fine. So losing 29 bucks in this trade. We got 20 Hasbro puts. Overall, I mean, we bought them while the stock was moving higher. But still, by the time the order got filled, the stock has already dropped. The trade was described in our 13 Market Moves daily video, basically saying, hey, it's the same chart pattern that we have identified in RCL. So if you haven't watched that video, guys, it was posted on February 9, 2020, specifically going through the one chart pattern that you should be using for trading earnings reports this week. So in the video today, we explained exactly how this chart of Hasbro was almost an ideal match with the chart of RCL last week, pointing to a reversal and a drop. So the goal was to actually come in and short this on the bounce. So anyways, with that said, we want to set a limit order to actually sell these guys. So we're going to sell the position, 20 of them. We can set a limit order there at about $3. So that will put us at about 6K in the account. So I mean, if it reverses another, $3-4, I mean, it's likely to possibly hit a level of 95. But so far, we're targeting for the reversal to maybe hit a level of 99, and the stock is at about 105 right now. So what we want to do is set a limit order at about 3.45 here. Submit it. So as you can see, the trade now is making 369 bucks. I mean, it's not bad considering, we started with, what, $1,500? And we had a horrible execution of actually trying to get into this trade. So we want to have this limit order just sit there and do this. And by the way, guys, we're trading today with interactive brokers. We have a lot of new subscribers from around the world, and a lot of them are using interactive brokers. So they've actually asked me to trade on interactive. To show them how I'm actually going about these trades. Now, in my view, there are actually some good things to the software, but as far as the charting part of the software, I believe it is inferior to Thinkorswim. But nonetheless, once you actually try to play around with this and try to get good at utilizing this, I mean, it's not a bad alternative for anybody that is overseas that is trying to trade the United States market. Now, you have to, again, probably look at the charts part before you go in and place these trades. You shouldn't be doing that at the same time you're trying to, because the chart part of the software here is just not as good. So you should calculate your trades ahead of time, and when you're going in, you're just focused here basically on executing your plan and trading that you have set before the market even opened. Okay, so with that said, we'll review the trade shortly, guys, but let me go ahead and finish setting that limit order. There it is, submit. And you'll see this order appear right here. So I've got a sell order sitting there to take this position out when the stock drops. We're calculating the drop of about $6. That should get us real close to this price. Especially, well, it really depends on how quick the drop could come. So given the fact that the stock is bouncing, okay, so now it's at 103.51, 103.30. So we should see it spike in these contracts valuation pretty quick here if we're getting to this 101 level. Then it's going to be, is the stock really going to break below that 101 fast to get us actually an opportunity to cash out at 345 today, or is it really just going to stall out here? And that's what we don't want. We don't want this trade to be stalling out right here. We want the trade to actually break this level, and the quicker it breaks this level, the quicker these 100 strike puts are actually going to produce the result we're looking for. So it's all about now watching the chart, watching exactly how this trade develops. If it stalls out, we may have to actually readjust that and get out of the trade earlier. So with that said, we'll do a quick follow-up shortly. Okay, guys, so far we pretty much doubled the account. It's 9:49 a.m. at this point. Hasbro is dropping about 102. Remember, we were buying these average of about 74 cents. So they're going for $1.50 now. That's why we're showing a $1,400 gain here. Whoops, bouncing. The stock is bouncing, so only making 866. But we didn't get into this trade to just you know, double the account. We're really trying to target this exit at 345. Now this could be modified slightly again based on how this chart is developing. So if we stall out at 101, probably may have to pull the trigger at around $2 or $2.50. Ideally, we think we should be able to close this at 345 by tomorrow. So we're in no rush to close this position today because this reversal in the stock, actually let's take a closer look here, switch it to the 1 minute. This reversal in the stock that was explained in the morning video, it is likely to continue based off the pre-existing condition. We're drawing a parallel between the RCL chart and this. It looks very similar. Now, if you study the RCL chart, it is likely to make a bounce at some point, and the importance there is not to panic and actually stay with the trade. So don't expect the stock to just completely drop. At the instances, it's going to make that, but the quicker the drop, the higher the probability becomes of a bounce. So it's important on one end for us to make sure it does pierce this level of 101. But if we get to this 98.99 level, we should be hitting this area to where we actually close in this, and that should coincide with the moment right before the stock is actually going to bounce. So a quick $4 move lower from here should trigger this order to get executed, and then we should be moving higher from there, guys. So at that point, we're not necessarily looking to play the bull side because that bounce is not likely to be long-lived. On the opposite, we want to target, if it hits 98.99 level, bounces back to, let's say, 101, we want to target that area on actually coming in and pulling the trigger and bomb puts again. So short the bounces, guys, is the subject of this trade. And if you're not sure how to do this, guys, there should be a link somewhere around this video, probably below this video, where you can actually click it, sign up to get more information on how you can learn how to trade, put together trades like this pretty much on a daily or weekly basis. So take action, click the link, and get better as a trader. Let's roll. 101.51 on a $1,500 investment. In less than 20 minutes, we're making $1,500. But still staying with the trade, guys. I know a lot of you would be jumping out right here, saying, "Hey, I'm good with this. Hey, they made $1,500, and only risking $1,500. I'm doubling my account in 20 minutes or less. I'm out, man. Leonardo, close, collect the gains." But guys, you have to understand the calculations of your trade. And if you don't know when it's time to hand in there, and if you don't know when it's time to jump out, then definitely you should take action. Click the link below, get more information so you can become the best trader you can be this year. Hey guys, what's going on? Today is February 12th, 2020, and we are still in this Hasbro position. HAS puts is what we've purchased yesterday. Remember, we're buying 20 of them, an average cost of about 74 cents. So today they are trading about $2. with interactive brokers, this part may be just a bit confusing because it shows you daily P&L. So since yesterday, we're up 1,400. So if we're to liquidate the position right now, net liquidity is going to be right at 4,000. So yesterday, remember, we started with $1,500. So the unrealized profit right here is 2.5K. But again, we did not get into this trade to just do a quick double. We actually targeting a certain level. So we're going to stick with the position. Again, there's certain bounces. What we were actually afraid of yesterday did take place. The stock did stall out right at that 101 level, and it would just hesitate to drop below. So we had to be extra patient. We're going to wait for that next leg lower to come in into the stock. And guys, if you don't know how to calculate these levels, it's absolutely crucial when you're trying to day trade or swing trade, understanding your levels. We see a lot of traders, they simply get in or get out of the position, contingent upon how much money they're making on the trade or contingent how much money they're losing on the trade. And that's just not a way to do it because it's going to be very difficult to stay consistent. So it is much better strategy is what we've discovered to actually understand chart patterns, divergences, 13 market moves that allow us to calculate things and be patient while other people are being emotional. So if any of those situations that I just described may apply to you, don't hesitate to click the link below this video, take action, get more education so you can become a better trader. We'll do a quick follow-up shortly. Okay, guys, it's 4:29 p.m., February 12th. Leonardo, you're still in this trade, dude. I mean, don't you want to take some other trades? Guys, patience pays off. Knowing your numbers does pay off. So at this point, the stock drops. It was hesitating here for some time, but the pattern in this didn't change. Sideways drop after the reversal yesterday. We've shown you the charts. We've shown you the reasons why. And so executing and staying in there is the other part of the equation of being successful at putting these trades together. So sometimes the market will really test you, but understanding why you're doing certain things really does matter, and it has a huge outcome as far as your profitability as a trader. So this is the chart of how Hasbro looks now. Do you see that we're able to identify this bounce, okay, and the reversal before all of this has actually taken place? And we did that by analyzing the chart of Royal Caribbean Cruise Line. Guys, this is where stuff gets really interesting. These correlations that look non-existent in the markets, but you're observing the same pattern that could be applied to multiple sectors. Guys, this is the kind of stuff, I wake up being excited for every morning. This is the kind of stuff that I love, okay? This is the kind of stuff that just like, boom, you nailed it. You figured it out. You're just like, whoa. And then it opens up your eyes to other things that other people they're blinded to see, okay? Because what do people want to do here, man? They want to buy the damn dip, okay? They want to, look, buying the damn dip is not going to make you a ton of money. It can make you a little bit of money. So, if you're like me, if you're aggressive, look, I understand this style of trading is not for everybody. I know. I'm aggressive. I like to set records. I'm like, I can't stay still. I just, I want to go out there and make shit happen. Not everybody's like that. I understand. So, my style of trading may not be suitable for everybody. But, if you have an inquisitive mind, you get excited about like cool stuff like this, guys, you just got to learn more. Because all I can do is share with you what I know, what helped me. And, hopefully, at some point, like, I'm not going to be here forever. So at some point, I hope that somebody maybe can study all of my stuff and, like, take it to even better level, next level, And it possibly could be somebody who has not even been born yet. But anyway, a bit rhetoric deviation here. Focus on the damn chart, okay? So this is when bulls were being bullish. And this is when the 13 markets for formula told us to buy the damn puts. All right. So, and guess what the best trade of the week was? based on this one chart you must know for trading this week. Yes, this is one chart, guys. This one chart pattern you should have known for last week. This is one chart pattern you should know for this week as well. This is why we're taking all this freaking time to review this. Do you guys see this? This is a mirror image of the chart I just shown. Now, with exception, this is a chart of Roku. Let's review the characteristics. Gap down. Look at the volume. Bounce, drop, bounce, drop, bounce, drop, bounce, drop, bounce, drop, bounce. Drop on much bigger volume, which actually communicates to you when you analyze everything else in the chart, including accumulation distribution. Everybody who's selling the hell out of the stock, it's likely to go lower. So we're likely to visit maybe a level of 122. So what you want to continue doing in the stock is short the bounces opposed to buying the dips. Now, as you guys know, if you bought 150 level puts, 145 puts, 140 puts, guys, this puts made insane amount of money Friday. So congratulations if you took the trade. So what do you actually think is another chart that highly resembles that same pattern after yesterday, Friday the 14th? Well, guess what? It's Expedia, guys. See, same setup. Huge gap on huge volume. Bounce, drop, bounce, drop, bounce, slight drop. Sometimes you will see a variation of this pattern where the thing is just kind of going to sit here. Now notice, it's no coincidence that we have said to select the 125 strike in Expedia puts. It coincides with this level of a death cross, and it could possibly stay here for another day or two, plus minus a couple of bucks, but ultimately it will actually close this gap. And a good indication of that is the fact that while apparently price action was pointing higher, accumulation distribution didn't do shit. It didn't do nothing. So it looked like they were buying, but in reality, guess what? Nobody was buying. And next 10 days, Expedia is likely to go lower. Could go sideways for a couple of days, but ultimately lower. So market keeps ripping higher, myth. Market keeps ripping higher. Only somebody that does not trade could leave a comment like this. Or somebody that buys calls that expire in 1 month or 3 months or 6 months out. So this is how a typical trader that has a longer time horizon would look at this chart. He's going to tell you, there's not, man, everything's bullish. It's not about like an uptrend. Look at, it just keeps going high. It just keeps going higher and higher and higher, and I'm just going to keep buying calls. For as long as this shit goes higher, I'm just going to buy calls. Okay? Now, here's the truth. What they're not telling you is this. When they were buying calls at point A, let's just pretend like we're going to cut this part of the chart out for a second. See, everything from here till here, pretty much solid uptrend, just looks so beautiful. If you're, a bull, like you're just like, yeah, everything is so nice. Now notice two things, okay? That this is the point where this bull that's buying more calls at this level, okay? This is what he's not seeing. He's not seeing this divergence that's observed right here by our charts divergences formula in course. Okay, so he's got no clue that this shit is coming. So what you will have is a situation where they're going to sell you like, oh, hold on, I'm a long-term bull, man. It don't matter. Hey, buddy, I understand the market can drop here and there. It's all right with me because I am a long-term bull. Okay, and so they're going to keep dancing. They're going to be happy for a minute until they wake up the next day. And what they're not going to tell you is this, is they're not seeing it anymore. And they get to a point F right here, which is like, oh, fuck. I should have listened to Leonardo. Okay, and they actually, when the market dropped one day, they're like, oh, man, I'm going to buy the dip. I'm going to buy some more. The market drops the second day, they're like, ooh, I don't know if I should buy some more. And so here it bounces a little bit like, yeah, they're like, yeah, I knew I was right. And then here comes the big fucking drop. And that's point F. Where they're like, oh, fuck, I shouldn't have bought the dip. Okay, and then market bounces. But guess what happens at point F frequently? That these long-term bulls are not going to admit What happens at point F is they actually sell their calls, because at this point the level of confidence all of a sudden, see, it's easy to be confident right here, how shit just keeps going higher and higher. Okay, now all of a sudden all of that shifts, and now they're scared and they're closing their positions. Now with that said, now if you actually come across a bull that will actually admit that yes indeed they bought at point A and they didn't sell at point F, guess what they will not admit to? They will not admit that even now that the market is higher at point B, okay, it's higher than it was in point A when they were buying calls. Now an actual 3-week time frame has gone by, and even though they were buying the market at a lower level and the market overall did go higher, their options now are worth less. Okay? Now no bull will actually fucking admit to this, but that's the reality. Okay, because options will decay. So if you bought your calls right here with a 1 month or 2 month or 3 month expiration, and if you persevered the F point, okay, by the time your options get here 3 weeks later, they're not worth more than what you have actually paid for them at point A, even though the market is technically higher. Well, hold on, Leonardo. This don't make sense. If this does not make sense, you guys have not been trading the markets long enough, and you should definitely click the link below and get some more information. Now, if you actually analyze this and you come to a conclusion that, fuck, Leonardo is actually right, then this should make sense to you. This is what 13 Markets Move formula helps you see as an active trader. See, the reality is, while it appears like the market is continuously moving higher, you have high frequency sell-offs. See, when I was showing you this thing, okay, what you were not paying attention to, it's a history of bounce, sell-off, bounce, sell-off, bounce, sell-off, bounce, sell-off. Now look, these things right here, guys, you're looking at them, you're like, man, I don't see no sell-off. Where is it, man? What are you talking about? Guys, do you see a sell-off right here? Like right here, do you see any sell? It looks like just boom, things are just rocketing higher. It looks like a tiny little, barely even a red candle. But this is how it actually looks right here. Damn. When did this happen? Well, it just happened, right? It just happened. Like all of these red sell-offs that just happened in the last few days while the market was moving higher. So understanding the formula, buying puts, okay, at the highs of the day, okay, would have made you a ton of money. Okay, so if you're not utilizing this, tells me a few things. Number one, you don't have a thorough understanding of what 13 Market Moves formula is and how to actually use it. Number two, you think you have an understanding, you've really never taken the course. You just think that you know it, but you really don't understand the details. Just kind of like I've shown you how to adjust your strike, how to adjust your entry, in order to make an average looking trade, what appears to be an average looking trade on the chart, actually appear to be highly profitable. Like if you're missing these few important details, guys, but you really want to take your trading to the next level, guys, this is your chance. Right? There's no reason, to wait. There's no reason to wait. Missing another Roku trade. I'm missing another Hasbro trade. I'm missing another market move where everybody's buying calls right here, but 13 Market Moves tell you, hold on, there's a high probability of a gap down tomorrow. And you buy the puts instead of the calls, and the market freaking flops 200 points at the open. And you make a killing. While bulls are saying, oh, I'm buying the dip. But they're actually going to show you how they're buying the dip. That's the funny part. Anyways, guys, this is it. Understand that there is a lot more stuff that an average person actually talks about the market that you need to know if you want to be a high performance trader. I will leave you with this final observation for a week. Okay, so this is the chart of Roku, right? And Roku's been in a downtrend, meaning that it's created this gap lower on strong volume. Every time it bounces, it drops, bounce, drop. Now it announced earnings report, it bounced and failed and dropped again on what appears to be the highest volume on this chart. So basically what we're saying, when bearish trend in a stock bounces on earnings and turns bearish again, that's clearly bearish for the stock and the market that is comprised of such stocks. Now, the question that I would like for you to type in the comments, what do you think it means when bullish trend stocks bounce higher on great earnings and actually turn bearish? And here we have a chart of Shopify. Highly bullish trend, very strong uptrend. All of a sudden the stock bounces, almost touches 595 and reverses. See, it's the same type of the reversal that you're seeing right here. The only exception in Roku pre-existing condition was bearish, so it's no surprise it bounces and it drops. Now the pre-existing condition here, it's highly bullish, and it's doing this. What does it mean? Type in your answer in the comments, and we'll discuss it in the next video, guys. Schedule a call to get all your questions answered. Guys, if you have any questions about this video, if you got any questions about courses, crazy trades and stuff, what's going to happen next week, who's going to win the damn election, we got to freaking give you all the answers for free in a 20-minute phone call. Schedule it now. This is how you do it. Go right here. Go right here, guys. TradingOptionsLive.com. Schedule a call. Click this button right here, guys. Check out some more live trading videos. Knock yourself out. VIP High Rollers Club. Guys, we only got 2 openings for the VIP High Rollers Club. We're entering a very critical freaking situation in the markets, okay? And if you meet the criteria, for the High Rollers Club, guys, you need to pull the trigger on this tonight. You need to do it this weekend. So life is short. Take a step forward today. As difficult as it could be for you, especially if you've been trading for years, do it now. Make that step forward today, or forever regret not knowing how your life could have been if you made the decision today to learn the 13 markets move formula, to get better as a trader, and never take no for an answer. Fuck it, let's do this. Let's roll. I wish you guys some awesome results next week. I'll catch you in the next trade soon.